hiatus and Kharif sowing is now gaining momentum. Some high-frequency indicators are also looking up again during the months of June and July. Our expectation is that activity is likely to gather pace with progressive upscaling of vaccinations, continued large policy support, buoyant exports, better adaptations to COVID-related protocols, and benign monetary and financial conditions. Consumer price inflation surprised on the upside in May, reflecting a combination of adverse supply shocks, elevated logistics costs, high global commodity prices, and domestic fuel taxes. In June, headline inflation remained above the tolerance level, but price momentum moderated. Also, core inflation softened from its peak in May. International crude oil prices remain volatile. Any moderation in prices as a consequence of OPEC plus agreement could contribute towards alleviating inflation pressures. On balance, the outlook for aggregate demand is improving, but underlying conditions are still weak. Aggregate supply is also lagging below pre-pandemic levels. While several steps have been taken to ease supply constraints, more needs to be done to restore supply-demand balance in a number of sectors of the economy. The recent inflationary pressures are evoking concerns, but the current assessment is that these pressures are transitory and largely driven by adverse supply-side factors. We are in the midst of an extraordinary situation arising from the pandemic. And this is a point which I have been highlighting almost in every monetary policy statement starting March last year. The conduct of monetary policy during the pandemic has been geared to maintain congenial financial conditions that nurture and rejuvenate growth. At this stage, therefore, continued policy support from all sides, fiscal, monetary, and sectoral, is required to nurture the nascent and hesitant recovery. The MPC continues to be conscious of its mandate of anchoring inflation expectations as soon as the prospects for strong and sustainable growth are assured. Accordingly, the MPC decided to retain the prevailing repo rate at 4% and continue with the accommodative stance with all its nuances. Let me now proceed and give an assessment, our assessment of the growth and inflation scenario. First, let me focus on domestic growth. Domestic economic activity has started normalizing with the ebbing of the second wave of the virus and the phased reopening of the economy. High-frequency indicators suggest that consumption, that's number one, both private and government. Number two, investment. And number three, external demand. I repeat, high-frequency indicators, and these are three aspects of the high-frequency indicators and the three aspects of growth which I am focusing now. High-frequency indicators suggest that consumption, both private and government, investment and external demand are all on the path of regaining traction. Let me now elaborate on each of these three aspects. Further easing of restrictions and increasing coverage of vaccinations are likely to boost private spending on goods and services, including travel, tourism, and recreational activities, propelling a broad-based recovery in aggregate demand. The robust outlook for agriculture and rural demand would continue to support private consumption. Urban demand is likely to accelerate with recovery in manufacturing and non-contact intensive services, release of pent-up demand, and the pace of vaccination. This is corroborated by encouraging movements in several high-frequency indicators, namely registration of automobiles, electricity consumption, non-oil, non-gold imports, consumer durable sales, and hiring of urban workers. The results of the July round of Reserve Bank's Consumer Confidence Survey suggest that 1 year ahead sentiments return to optimistic territory from historic lows. Early results from listed firms show that corporates have been able to maintain their healthy growth in sales, wage growth, and profitability, led by information technology firms primarily. This will also support aggregate disposable income of the consumers. Turning to investment, although investment demand is still anemic, improving capacity utilization, rising steel consumption, higher imports of capital goods, congenial monetary and financial conditions, and the economic packages announced by the government are expected to kickstart a long-awaited revival. Firms polled in the Reserve Bank's surveys expect expansion in production volumes and new orders in the second quarter of 21-22, and which they expect would sustain through the fourth quarter of the current financial year. And this bodes very well for investment. Innovation and working models adopted during the pandemic by businesses will continue to reap efficiency and productivity gains even after the pandemic recedes. This should help trigger a virtuous cycle of investment, employment, and growth. As regards external demand, it remained buoyant during the first quarter of 2021-22, and it was reflected very clearly in the increase in the volume of our exports, and this lent critical support to aggregate demand. Strong external demand is an opportunity for India, and further policy support should help in capitalizing on this. Global commodity prices and episodes of financial market volatility, together with vulnerability to new waves of infections, are, however, downside risks to economic activity. Taking all these factors into consideration, which I have now just spelled out, the projection for real GDP growth is retained at 9.5% for 2021-22. And this consists of, I'll give the quarterly breakup, this consists of 21.4% in Q1, 7.3% in Q2, 6.3% in Q3, and 6.1% in Q4 of 2021-22. Real GDP growth for Q1 22-23, that is next financial year, is projected at 17.2%. Let me now turn to inflation. Headline CPI inflation edged up sharply to 6.3% in May, driven by a broad-based pickup across all major groups on adverse supply shocks, sector-specific demand-supply mismatches, and spillovers from rising global commodity prices. It remained at 6.3% in June. However, core inflation registered an appreciable moderation in the month of June. The revival of the southwest monsoon and pickup in Kharif sowing, buffeted by adequate food stocks, should help in containing cereal price pressures in the months ahead. High-frequency food price indicators show some moderation in prices of edible oils and pulses. I repeat, high-frequency food price indicators show some moderation in prices of edible oils and pulses in the month of July, on the back of supply-side interventions by the government. Inflation in core services like house rentals remains below historical averages, reflecting subdued demand conditions. Crude oil prices are volatile, with implications for imported cost pressures on inflation. The combination of elevated prices of industrial raw materials, high pump prices of petrol and diesel with their second round effects, and logistics costs continue to impinge adversely on cost conditions for manufacturing and services, although, I repeat, although weak demand conditions are tempering the pass-through to output prices and core inflation. Before the onset of the pandemic, headline inflation and inflationary expectations were well anchored at 4%, the gains from which need to be consolidated and preserved. Stability in inflation rate fosters credibility of the monetary policy framework and augurs well for anchoring inflation expectations. This in turn reduces uncertainty for investors, reduces term and risk premia, increases external competitiveness, and thus is growth promoting. Since the start of the pandemic, the MPC has prioritized revival of growth to mitigate the impact of the pandemic. The available data point to exogenous and largely temporary supply shocks driving the inflation process, validating the MPC's decision to look through inflation. The supply side drivers could be transitory while demand pull pressures remain inert, given the slack in the economy. A preemptive monetary policy response at this stage may kill the nascent and hesitant recovery that is trying to secure a foothold in extremely difficult conditions. Inflation may remain close to upper tolerance band up to the second quarter of 21-22, but these pressures should ebb in the third quarter of 21-22 on account of Kharif harvest arrivals and as supply side measures take effect. Taking into consideration all these factors, CPI inflation is now projected at 5.7% during 21-22, and this consists of 5.9% in Q2, 5.3% in Q3, and 5.8% in Q4 of 21-22, with risks broadly balanced. CPI inflation for the first quarter of 22-23, that is the next financial year, is projected at 5.1%. I would now like to focus on our assessment of the liquidity and financial market conditions. During June-July, global financial markets turned volatile in response to higher inflation numbers in several countries and the fear of early policy normalization with skewed economic recovery in some advanced economies. These developments need to be factored into our policy metrics for framing an appropriate response, given that safeguarding the economy, the domestic economy, from the vicissitudes of global spillovers and ensuring financial stability remain a top priority of the Reserve Bank. Nonetheless, domestic macroeconomic situation and evolving growth inflation dynamics will continue to be the principal pivot of monetary policy actions. The Reserve Bank, through its market operations, both conventional and unconventional, has maintained ample surplus liquidity since the onset of the pandemic to ensure easing of financial conditions in support of domestic demand. Buoyed by renewed vigor of capital inflows and the Reserve Bank's purchase of government securities in the secondary market, the total absorption through reverse repos surged from a daily average of rupees 5.7 lakh crore in June to 6.8 lakh crore in July 21, that is July 2021, and further to 8.5 lakh crore in August 2021 so far, and this is the figure up to the 4th of August. Under the revised liquidity framework announced on February 6th, 2020, that is February 6th of last year, the Reserve Bank has been conducting 14-day variable reverse repo rate auctions, what I call the VRRR auctions, as its main liquidity operation. With the commencement of normal liquidity operations, the VRRR, which was temporarily held in abeyance during the pandemic, has been reintroduced since 15th January 2021, and the initial absorption of rupees 2 lakh crore has been rolled over in subsequent fortnightly auctions. In parallel, access to fixed rate overnight reverse repo has been kept open. Markets have adopted and even welcomed the VRRR in view of the higher remuneration it offers relative to the fixed rate overnight reverse repo. Fears that the recommencement of the VRRR tantamounts to liquidity tightening have been substantially allayed. We have seen higher appetite of VRR in terms of our experience in the recent auctions. and this is reflected in the bid cover ratio, because the bid cover ratios are far higher, have been much higher than the total quantum which is put to auction, that is 2 lakh crores. So I repeat, we have seen higher appetite for VRRR in terms of bid cover ratio in the recent auctions. And this also we have seen over a period of time. Considering all these aspects, it has now been decided to conduct fortnightly VRRR auctions of rupees 2.5 lakh crore on 13th August, 3 lakh crore on 27th August, 3.5 lakh crore on 9th September, and 4 lakh crore on September 24th, 2021. So as you can see, in a calibrated manner, we are increasing the quantum, increasing the quantum that is being put under auction under the VRRR window, and this is mainly in response to the market appetite for VRRR auctions. And simultaneously, our overnight fixed reverse repo window also remains open. So it's a voluntary kind of thing which the investors and the banks, particularly the banks, can opt for. Now, these enhanced VRR auctions should not be misread as a reversal of the accommodative policy stance, as the amount absorbed under the fixed rate reverse repo is expected, I repeat again, as the amount absorbed under the fixed reverse repo is expected to remain more than 4 lakh crore even at the end of September of this year. Needless to add that the amount adopted under the VRRR window forms part of system liquidity. So system liquidity consists of both VRRR quantum as well as what is absorbed by the Reserve Bank at the end of every day through fixed rate reverse repo windows. The Reserve Bank's secondary market GSEC acquisition program, GSAP, has been successful in anchoring yield expectations while eliciting keen response from market participants. We propose to conduct 2 more auctions of rupees 25,000 crore each on 12th August and 26th August 2021 under the GSAP 2.0. We will continue to undertake these auctions and other operations like open market operations, that is OMOs, and Operation Twist, OT, among others, and calibrate them in line with the evolving macroeconomic and financial conditions. It is necessary to have active trading, I repeat and I reiterate, it is necessary to have active trading in all segments of the yield curve for its orderly evolution. Our recent GSAP auctions that have focused on securities across the maturity spectrum are intended to ensure that all segments of the yield curve remain liquid. Furthermore, our options are always open to include both off-the-run and on-the-run securities in the GSAP auctions and in the Operation Twist. It is expected that secondary market volumes would pick up and market participants take positions that lead to two-way movements in the yields. Our endeavor as the debt manager of both central and state governments has been to ensure an orderly completion of the borrowing programs at a reasonable cost while minimizing the rollover risk. In my earlier statements, I have emphasized orderly evolution of the yield curve as a public good in which both market participants and the Reserve Bank have a shared responsibility. As GSEC yields serve as a benchmark and have a high signaling value for other segments of the debt market, guidance on orderly path of yields was provided through auction cutoffs, devolvements, green shoe options, cancellations in the primary market auctions. The introduction of uniform price auctions announced recently for issuance of securities up to 14 years tenor is expected to mitigate the risks that bidders may face in primary segment. The decision of the government, and this is very important, the decision of the government to accommodate the GST compensation payment to states for the first half of the year within the existing cash balances should assuage the market concerns on the size of the government's borrowing program this year. The efficacy of RBI's monetary policy measures and actions is reflected in the significant improvement in transmission during the current easing cycle. The reduction in repo rate by 250 basis points since February 2019 has resulted in a cumulative decline by 217 basis points, 217, that is 217 basis points in the weighted average lending rate on fresh rupee loans. Domestic borrowing costs have eased, including interest rates on market instruments like corporate bonds, debentures, CPs, CDs, and T-bills. In the credit market, transmission to lending rate has been stronger for MSMEs, housing, and also large industries. The low interest rate regime has also helped the housing sector to reduce the household sector. The low interest regime has also helped the household sector to reduce the debt burden, to reduce the loan servicing. Let me read it again. The low interest regime has also helped the household sector reduce the burden of loan servicing. The significant reduction in interest rates on personal housing loans and loans to commercial real estate sector augur well for the economy, as these sectors have extensive backward and forward linkages and are employment intensive. Let me now turn to the additional measures which I propose to announce, which I am announcing on behalf of the Reserve Bank of India. After the onset of the pandemic, the RBI has announced more than 100 measures to mitigate the impact of the pandemic. Going forward, our endeavor would be to continue to monitor the measures which are still under operation to ensure that the benefit of all the measures which we have announced, that is these 100 measures which we have announced, our effort would be to monitor them and to ensure that the benefit percolate down to the targeted stakeholders. Against this backdrop and based on our continuing assessment of macroeconomic situation and financial market conditions, certain additional measures are being announced today. The details of these measures set out in the statement on developmental and regulatory policies, which forms part, which forms part of the monetary policy statement as Part B, that will be uploaded, and this will be, as you know, will be uploaded in the RBI website as soon as my statement is over. So a copy of my statement, a copy of the monetary policy committee, that is MPC statement, including the announcements which I am making with regard to additional measures. As usual, they have been uploaded in the RBI website immediately after my statement is over. And let me also say that certain notifications which are also which are as a consequence of the announcements which I have already made and which I am now going to make, they will also be issued either today or in the next few days. The first measure relates to on-tap TLTRO scheme extension of deadline. The scope of the on-tap TLTRO scheme, initially announced on 9th October last year for 5 years, was further extended to stressed sectors identified by the KV Kamath Committee in December 2020 and bank lending to NBFCs in February 21. The operating period of the scheme was also extended in phases till September 30th, 2021. Given the nascent and fragile economic recovery, it has now been decided to extend the on-tap TLTRO scheme further by a period of 3 months, that is till December 31st, 2021. The second measure relates to marginal standing facility, that is MSF, extension in period of relaxation. On 27th March last year, banks were allowed to avail of funds under the marginal standing facility, that is MSF, by dipping into the statutory liquidity ratio up to an additional 1% of net demand and time liabilities, that is NDTL, that is cumulatively up to 3% of the NDTL. To provide comfort to banks on their liquidity requirements, including meeting their liquidity coverage ratio requirement, this relaxation, which is currently available till September 30th of this year, is now being extended for a further period of 3 months, that is up to 31st December 2021. This dispensation provides increased access to funds to the extent of rupees 1.62 lakh crore and qualifies as high quality liquidity assets HQLA for calculation of the LCR. The next measure relates to LIBOR transition, review of guidelines, and review of guidelines especially with reference to export credit on foreign currency and restructuring of derivative contracts. The transition away from London interbank offered rate, that is LIBOR, is a significant event that poses certain challenges for banks and the financial system. In fact, it's not just a challenge for the banking system and the financial system in India, but it's equally a big challenge for the banking and financial sectors across the world, advanced economies, emerging market economies, and every central bank in each of these economies is trying to deal with the problem in its own way. And they have been spelling out their measures. We have also spelled out certain measures in the recent past. The RBI has been engaged with the banks and market bodies to proactively take steps to ensure that the transition is orderly and not disruptive. The Reserve Bank has also issued advisories to ensure a smooth transition for regulated entities and financial markets. In this context, it has been decided to amend the guidelines relating to two aspects, guidelines related to number one, export credit in foreign currency, and number two, restructuring of derivative contracts. Banks will be permitted to extend export credit in foreign currency using any other widely accepted alternative reference rate in the currency concerned. Since the change in reference rate from LIBOR is a force majeure, it's a force majeure event, banks are also being advised that change in reference rate from LIBOR or LIBOR-related benchmarks to an alternative reference rate will not be treated as restructuring. The next measure relates to deferral of deadline for achievement of financial parameters under the Resolution Framework 1.0. The resolution plans implemented under the Resolution Framework for COVID-19 related stress announced on 6th August 2020, exactly 1 year ago. They require sector-specific thresholds to be met in respect of certain financial parameters. Of these parameters, the thresholds in respect of 4 parameters relate to operational performance of the borrowing entities. And these 4 parameters are total debt to EBITDA ratio, current ratio, debt service coverage ratio, and average debt service coverage ratio. These ratios are required to be met by 31st March 2022. Now, recognizing the adverse impact of the second wave of COVID-19 and the resultant difficulties on revival of businesses and in meeting the operational parameters and the difficulty in meeting the operational parameters, it has been decided to defer the target date for meeting the specified thresholds, these specified 4 thresholds, which are mainly operational parameters. So it has been decided to defer the target date for meeting the specified thresholds in respect of the above 4 parameters to 1st October 2022. So we are extending it by a 6 months period from 31st March 22 to 1st October 2022. Let me now summarize and conclude. As the COVID second wave ebbs, there is optimism that with adequate pandemic protocols and ramp up in vaccination rate, we should be able to tide over a third wave if it occurs. As a nation, we should continue to be vigilant and ready to proactively deal with any resurgence of the pandemic with more rapidly transmissible mutants of the virus should it happen. The recovery remains uneven across sectors and needs to be supported by all policymakers. The Reserve Bank remains in whatever it takes mode with a readiness to deploy all its policy levers, monetary, prudential, and regulatory. In parallel, our focus on preservation of financial stability continues. At this juncture, our overarching priority is that growth impulses are nurtured to ensure a durable recovery along a sustainable growth path with stability. In this endeavor, we have consciously chosen the path of optimism over gloom, inspired by Mahatma Gandhi. And I quote Mahatma Gandhi, quote, I am an irrepressible optimist, but I always base my optimism on solid facts. Thank you. Stay safe, stay well. Namaskar.